In Chapter 7, we're going to be looking at the accounting for receivables. And what we're really talking about here are accounts receivable. The term accounts receivable and the basic journal entries for accounts receivable, for when you first record that accounts receivable, that's not new. We've already looked at that in previous chapters. But we're going to be looking more in depth as to all of the things related to accounts receivable. What we're going to spend most of our time on is any time you offer credit to someone, meaning that they can pay you at some point in the future, that is a type of receivable. But just the way human nature and business works, anytime you offer someone credit, there is always that chance that you will not get paid back. And we call that bad debt expense. We're going to spend a large portion of this lecture and of this chapter around the accounting for that bad debt expense, and we'll move to that in a couple slides. But first, we're just going to go ahead and wrap our minds around accounts receivable and refresh us so that we're all at the same point. So first, as you already know, a receivable is an amount due from another party. And whenever you have accounts receivable for multiple different people, meaning that you have multiple customers who owe you money, not only do you have to keep an accounts receivable general ledger account that keeps the sum of all of those amounts due, but you also need to maintain separate accounts for each customer. You have to do that because you have to specifically track how much each particular customer has purchased, what they have paid, and what they still owe you. You have to track that because if you send out a bill to someone, they may or may not go ahead and pay you what is due. So you have to keep track of that, and you'll have to follow up with customers who have not paid you on time, and so on. So our accounts receivable, just a basic example, this is not new, but on July 1st we had a company and they made a sale. It's a credit sale of $950, and then a couple days later, that same day, we make a collection from another sale. So let's look at these basic entries. First, let's record this credit sale of $950. Anytime we make a sale, we want to record that sales revenue. That's what we're showing with the credit here, $950. And then this is a credit sale, meaning we did not get cash. We still get another asset, and that is the promise to receive cash. So we're showing here this is our accounts receivable. Then we have another transaction. We're told that we make a collection of $750 from a prior credit sale. So what's happening here? We are receiving cash, so we want to show that cash being put on our books with our debit here. And then we need to get rid of this account receivable because remember, the account receivable represents a promise someone has to pay you money. Now that they have paid us that money, we need to take this account receivable off the books because they have fulfilled that promise. Again, these entries are not new, but just to get us started on the accounts receivable topic. I'm going to show you a little more detail. As I mentioned, we'll have one general ledger account, and that's for the overall accounts receivable, and whatever the ending balance in accounts receivable is at the end of a period, that's what's going to show up on your actual balance sheet. But then we can look here and you have some additional information. We have the specific ledgers for our various customers. You can see here we've got 2 of our customers, and the ending balance within those ledgers are what make up the total balance in our accounts receivable. And keep in mind, it's this total balance that we're going to see on our balance sheet. But we still have to keep track of what someone owes us and what they have paid us in separate ledgers for each specific customer. So along the same lines of accounts receivable, we're going to quickly talk about the use of credit cards. So what we're talking about is if you are a business and you allow your customers to pay you with a credit card. Now what's going on with a credit card is a customer is making a contract with the credit card company. So when they purchase something and they're using their credit card, You are getting your money or your cash from the credit card company, and then it is up to the credit card company to follow up and get paid by that customer. So the credit card company is acting as a middleman. They are providing a service to both you and to your customer. They are the ones who are assuming the risk that that customer may or may not end up actually paying the cash that is owed to that credit card company. On the other hand, you as a business are going to be paid immediately or very soon by that credit card company. So that's the basic advantage of allowing customers to use a credit card. So why would you not accept a credit card? Why do you sometimes go places and maybe there's a sign saying that they don't accept American Express or they don't accept Discover? Why is that? There are many benefits to using credit cards, but there's one problem or one downfall, and that's that credit card companies charge a fee to you as a business for allowing your customers to use their card. And typically it's a fee on the revenue from each and every sale. So these fees can really add up, and over the past couple of years, these fees have really increased. So let's look at how this works. We have a company who makes a sale, and that sale is going to be paid for by the customer with a credit card. The sale is a $100 sale, but the fee from the credit card company is 4%. So what's happening here is they have made a sale of $100, but they're only going to get a portion of that in their own bank account because this 4% is not going to come to them. This is going to be a type of a credit card expense. So this is a new type of expense. 4% multiplied by $100. We had a $4 credit card expense. And you can see here we have the cash of $96. So oftentimes you'll see that some of the cards that companies won't accept are typically American Express or Discover. And the reasoning there is that the fee that those companies charge is typically higher than the fees that some of your other MasterCard or Visa type companies charge. So just so you can kind of get an understanding of how some of these things can affect the actual business world that you and I are working in. So let's look at some of the other examples. Most of the time when companies accept a credit card, they are going to immediately get that cash as soon as that credit card is swiped. However, there are other instances where a company, instead of having that electronic and immediate cash payment, they have to later remit their credit card sales receipts to the credit card company, and then they have to wait for that cash payment. When I was in college, I worked at a hair salon, and I was the receptionist there. And that hair salon didn't have a reliable internet connection. And this is what we did. We accepted credit cards throughout the day, and then at the end of every day we would print out all those receipts, and then we would send one electronic receipt to the credit card company, and it's at that point that we would get paid. So we didn't get paid multiple times through the day. It was just when we totaled everything up together at the end of the day. So that's why this happens sometimes. It just depends on the accessibility that a particular company has. So we have the same example here, and we have accepted a credit card for our $100 sale. But let's look at how this works, because again, this is a company that has to wait, and then they will remit their receipts to the credit card company, and at that point they get their cash. So what we have here, the numbers are still the same. We've got the credit card expense of $4, sales of $100, but then up here, because they're not getting their cash immediately, they have an accounts receivable. This is not an account receivable with the specific customer. It's an account receivable with the credit card company, because this is now who owes us this money. So we have an account receivable with the credit card company, and then when we actually remit those receipts to the credit card company, then we'll receive our cash. So that's what we're showing here about 5 days later. We're showing that we received the cash. That's why we're debiting the cash for $96,000. And then we need to take that account receivable off of the books because the credit card company has paid us what we owed. Now, I want to go ahead and emphasize what's going on with the customer. The customer came in, they purchased their $100 worth of goods, and when they made that purchase with their credit card, two agreements happened. The first agreement is that that customer now owes the $100 to the credit card company. So their payable is with the credit card company, and the credit card company has an account receivable saying that that specific customer needs to pay them. Then we, as the business who made the sale, when we make the sale, we have made an agreement with the credit card company. And that agreement is that that credit card company owes us the $96. Now, depending on whether we get that money immediately or if we get it with some type of delay, that will determine whether we get that cash today or whether we have an account receivable, which is simply a promise that the credit card company is going to pay us when we remit all of our receipts. So that's just an understanding of how credit cards work and how we have accounts receivable related to those credit cards. Now, another type of accounts receivable that is a new accounts receivable, we haven't talked about it up to this point, is an installment accounts receivable. This is where a customer owes a certain sum of money to a company, but rather than paying it all at one time, they're going to pay it over time. So typically they'll make payments each month. A typical example is if you purchase a car from any type of car dealership. If that car dealership provides their own financing, that's a great example of an installment accounts receivable. And you can see here, just a quick note, Ford Motor Company, so Ford Cars, reports more than $70 billion in installment receivables on their balance sheet. So that's a huge amount of money, $70 billion, and that's simply because they're selling cars on their lots and they're providing their own financing, meaning that it is actually Ford Motor Company that's providing the financing, meaning that their customers could go to a bank and get a loan from the bank and then they have financing through the bank, or they could get their financing right there at the dealership. And so that's where the $70 billion in installment receivables is coming from. So as I mentioned at the very opening of this chapter, anytime we talk about a promise, promises can always be broken. An account receivable is a promise for what? It's a promise to receive cash at some point in the future. So anytime we have a promise, knowing that those promises can be broken, we need to think about how do we account for those broken promises. And the way we do that is we recognize a new type of expense, and that's called a bad debt expense. We're going to talk about two basic methods for accounting for bad debt expense. We've got the write-off method, and that's what we're going to talk about first, and then we have the allowance method. I'm going to go ahead and tell you that the write-off method, or the direct write-off method, this is not GAAP accounting. On the other hand, the allowance method is. The reason we're going to talk about the direct write-off method is because anytime you're working with a small company, they're typically going to use this direct write-off method because it's easier. And that's fine as long as a company is not required to use GAAP accounting, they can use this direct write-off method. Before we actually get into the two different methods, I want to go ahead and discuss why the allowance method is GAAP accounting, whereas the direct write-off method is not. The premise behind the direct write-off method is that we do not write off an accounts receivable as being bad debt until we are actually told or we determine that we're not going to get that money. So we write it off when we find out we're not going to get it. On the other hand, the allowance method is based off of an estimate. The way this works is typically a company will look at their past history with their customers, or they'll look at the history of whatever industry they're in to look at what percentages of accounts receivable typically end up being bad debts, meaning that those accounts receivable never get paid. So let's say that I own some type of company. It's a company that makes bicycles. and I look at the history of my company, or I just look at what happens in our industry in general, and I see that typically 2% of our accounts receivable end up being bad debt. The allowance method uses that history, or that 2% amount, to create an allowance for bad debt. So anytime we make a sale, we'll go ahead and recognize a small portion of that sale will probably not be paid back to us. So the difference here is that the allowance method, whenever we make revenue, we go ahead and we record a portion of bad debt expense. That's based off of an estimate of what we think is bad debt, but it's the best thing we have. It's our best estimate. Whereas the direct write-off method, when we receive money, we make a sale, we go ahead and record that sale, and then it could be 2 years later that we finally determine that we're not going to get that money. So at that point, we go ahead and recognize the bad debt expense. So you can see here there's a timing difference. And if you'll think way back from the very beginning of this class, we talked about the matching principle. The matching principle tells us we want to recognize our expenses in the same period of the revenues that they helped us to earn. So you can see here the direct write-off method, we're not recognizing any bad debt expense until we actually know that it is bad debt. So it could be a year later, it could be 2 years later, but we're not recognizing this expense when we are receiving the revenue. On the other hand, the allowance method, even though we do not know exactly how much will end up being bad debt, we have a pretty good estimate, and that's based off of the history for our company or our industry. So in order to make sure that we are following the matching principle, anytime we recognize accounts receivable revenue, or revenue that has an account receivable, it's not a cash revenue, we're going to go ahead and recognize, based on our best guess, a portion of bad debt expense. So now that you understand the two different methods, we're actually going to get into how we actually do those. We're going to start with this direct write-off method, and then we'll move into our allowance methods. So like I said, the direct write-off method, we do not recognize bad debt expense until we find out that we're not going to get paid. So maybe we'll get a notice from a customer that they're going bankrupt and they're not going to pay us. Or maybe, we find that we can no longer contact a customer, or that we see we have followed up with a customer for 2 or 3 years and they still haven't paid us. So we go ahead and write it off as bad debt, and we leave that person alone because it's simply not worth it. So you can see here our company has determined on January 23rd that it is not going to collect $520 that they were owed by their customer. So you can see here, we're not recognizing any revenue at this point. This is a sale that happened at some point in the future. I don't know when, but it's not recent. So all we're doing here is recognizing this expense because we have now determined we're not going to get that money. So we recognize bad debt expense. Anytime you're recording an expense, we're doing that with a debit. So this works just like any type of normal expense. Bad debt expense is being debited. And then we've determined we're not going to get the cash for that account receivable. So if that account receivable no longer has value, we need to take it off of the books. And we do that by taking the account receivable off with a credit. So you can see here bad debt expense for $520, and then the account receivable for $520. And notice here we have the name of the customer, and that's simply so that we can keep track of whose bad debt this was and whose account we wrote off. So then what happens if for some reason this customer does decide to pay us? Okay, we need to reverse our previous entry where we wrote it off, and then we need to show the collection of that account receivable. So for some reason we thought we were not going to get this money, but then a month later for some reason they ended up paying us. So first we have to put that account receivable back on our books. So we put it back on our books just like we record any receivable. We show that with a debit. and we need to get that bad debt expense off of our books. Typically, you do not credit an expense account because usually you record an expense and then you leave it there. But in this case, it is determined that this is not actually an expense, so we need to get rid of it. The way we do that is by crediting bad debt expense, and this is simply reversing our previous entry and making it like that previous entry never happened. So then we need to show the collection of this account receivable. So we show that we get cash, and now we take that account receivable off because we have been paid and they have fulfilled their promise to pay us. So we've talked about the matching principle, and if you'll remember that we want to match our expenses with the revenue that they helped earn, and keep in mind that the direct write-off method is not GAAP accounting because it does not meet that matching principle. I mentioned that there are many companies that use the direct write-off method simply because they're not required to use GAAP accounting. So they can use the direct write-off method because it is easier. If a company has bad debt expense that is immaterial, meaning it's such a small amount that it's insignificant, they could use this direct write-off method. But I would always caution any of my clients to go ahead and use the allowance method, use GAAP accounting, because if their bad debt expense slowly increases over the years, you don't want to all of a sudden come to a year when you've been using the direct write-off method, and then all of a sudden you come to the end of the year and you realize that the amount of bad debt expense is no longer immaterial. It is material, meaning that we need to properly account for it. So in that case, we would have to go back and fix things and go back and use the allowance method. So anytime I was in public accounting, I would always go ahead and suggest to any of my public companies or those companies who are required to use GAAP to go ahead and use the allowance method even if their bad debt expense was immaterial. Go ahead and use that allowance method in case that number creeps up and ends up being material. You want to make sure that you were already accounting for it the correct way. So now let's look at our allowance method. Remember, the allowance method is simply the idea that we want to go ahead and estimate what our bad debts will be, and we'll record those along with the revenue that they helped to earn. When we're looking at the allowance method, there are actually two different techniques that we can use to carry out the allowance method of accounting for bad debts. So you can see here we've got two basic advantages of using the allowance method. The first is simply that the allowance method helps us to meet the matching principle. And the second is that when we're using the allowance method, the number on our balance sheet is not going to be the total amount of accounts receivable. We're going to be shown the amounts in accounts receivable, but we're also going to be shown the information about what portion we estimate will not be able to be collected. So it shows us the accounts receivable on our balance sheet that we actually think we're going to collect. So it's not everything that we allowed as an account receivable. It's going to give us a better picture of what did we allow as an account receivable and what do we honestly think that we're going to collect from those accounts receivable. So it gives us a better picture of what we can expect to be coming in the future. So here's just a basic example of how we record our bad debt expense when we're using the allowance method. You can see down here our journal entry. If you'll think back to when we were using the direct write-off method, we would show bad debt expense and then we would write off the accounts receivable by going ahead and crediting the account receivable to take it off of our books. Now in this case, remember that we are going to be recording these bad debt expenses before we actually know exactly which accounts we're not going to get paid on. So we can't go ahead and mark down our account receivable because we don't know which receivable we're not going to get. So instead we make a holding account. and we call that the allowance for doubtful accounts. And again, this is a type of contra account. It's a contra receivable account. So you can see here we have a company, they had credit sales of $300,000 during the first year of their operations. At the end of the first year, $20,000 of their credit sales remained uncollected. So based on their previous experience, we estimate that of the $20,000 that we have in accounts receivable, $1,500 will be uncollectible. So based on the matching principle, we want to recognize the fact that we don't think we're going to get all of these accounts receivable back. We want to go ahead and recognize this as an expense in the same year of the revenue that it's related to. So when we're closing our books, we want to go ahead and make this journal entry. Oftentimes, companies will make this journal entry at the end of every month, or at least at the end of every quarter, but just in this very simple example, we're doing it just at the end of the year. So to recognize this, we're going to show bad debt expense of $1,500, and then we show the allowance for doubtful accounts of $1,500. Again, we don't know if it will be customer A, B, or C that ends up being uncollectible. So we cannot go ahead and write down that account receivable, because again, we don't know which receivables we'll end up not getting. But what we do know is that we expect in total that $1,500 will not ever be paid to us. So we put in this holding account, the allowance for doubtful accounts. Now I want us to keep in mind that this is an estimate. So as we end up seeing that some of this credit sales are not actually coming in, we're going to be adjusting this holding account, because remember, this is our estimate, and as we find out that we're truly not going to collect on a specific receivable, we'll need to update this account, and you'll see how we do that as we go on. So you can see here again we had the credit sales of $300,000, and at the end of the year we still had $200,000 of accounts receivable uncollected, and we estimate that $1,500 is uncollectible. So how is this going to look on our balance sheet? You can see here we've got our accounts receivable of $20,000. Then we show the portion in our allowance for doubtful accounts. And that shows us that our total or our net amount in our current assets for accounts receivable is $18,500. So you see we're being more conservative. We're showing the amount that we actually expect to get in rather than the full $20,000, because we know in truth we're not going to get all of this. Now again, this is an estimate and it's not perfect, so we'll make adjustments as they're needed. So what happens when we find out that we actually are not going to get a specific account? This is now no longer an estimate. Remember, we had originally booked our estimate, let me go back 2 slides, that in total we expect we're not going to get $1,500 of these accounts receivable. Now when we find out a specific portion of this is not collected, we need to take it out of this estimate account because it's no longer an estimate. And you can see how we do this when we actually write off the specific account. So we found out that this person or this customer's account is uncollectible. So you can see here this is no longer an estimate, so we need to take it out of that estimate or that holding account, this allowance account. We take it out by reversing it, so we're going to be debiting the allowance for doubtful accounts for the full amount of this specific customer's amount, and then we need to go ahead and write off this account receivable, meaning take this account receivable off the books. So if you look down here into our T accounts, let's concentrate on the allowance account. Remember, this allowance represents our estimate of what we think will actually end up being bad debt. So we originally booked the $1,500 that we estimate to be uncollectible. Now we have determined that $520 is not collectible. So this $520 is no longer an estimate. We actually know that this is uncollectible. So that's why we are taking it out of the allowance account here with the debit. You can see this debit over here, because when we net these together, you'll see that this decreases the amount of our estimate that we expect to still be bad debt or to still end up being uncollectible in the future. So again, just to get an understanding of how this holding account works. Now, anytime we write off a bad debt, the bottom line is that the write-off does not affect the realizable value of our accounts receivable. You can see here before the write-off, we had that $18,500 in accounts receivable that we expect to realize or we expect to get, and then we have the same amount after the write-off. That's because when we had the write-off, we decreased the amount in our accounts receivable when we wrote off that specific account, but we also decreased our allowance because now that full $1,500 is not estimated. Now it's $1,500 minus the $520 that we actually know we won't receive. So that's how we end up having the same net realizable value both before and after the write-off. So then again, like we looked at with the direct write-off method, what happens when we actually recover a bad debt? So in this case, this customer was hoping to restore their credit standing. So we had determined that we were not going to get a payment from them, but for some reason they're hoping to get their credit score back up. So they're going back and they're paying their bad debts in hopes of increasing their credit score or getting some of those bad things off of their credit report. So that's one reason why you might recover a bad debt. So in this case, we are actually going to get the money back, and here's how we show that. We reverse the write-off. So here we put the account receivable back on our books, and then we put this $520 back into the allowance because we're simply reversing that write-off. And then we show that we're getting the cash, and then we go ahead and take that account receivable off because we got what they had promised. So this promise is no longer available to us, so we need to take it off the books. Now, as I mentioned, there are two basic methods that we can use to carry out the allowance method of accounting for bad debts. We've got the percent of sales method, and then we have our accounts receivable methods, the percent of accounts receivable or the aging of accounts receivable. We're going to start with the percent of sales method because this is the most simplistic method. So you can see here just how we compute the percent of sales method is any time we make a sale, we have a certain percentage that we know is typically bad debt. So if we make a sale and that sale is on account, or meaning we're not getting cash, we're getting an account receivable, then we'll go ahead and apply the percentage to those sales made on account, and we will recognize our estimated bad debt expense. So here we have a company, they had credit sales of $400,000, and they estimate that 0.6% of their credit sales will end up being uncollectible. So how do we record this? You can see we have the $400,000 in credit sales, multiply that by 0.6%, and that tells us we need to go ahead and recognize bad debt expense for the current period of $2,400. Now I want to note here, they made it easy for us. The full amount is credit sales. However, sometimes a problem will tell you that we had total sales of $600,000. $200,000 of those were cash sales, so then we would have to solve for the fact that $400,000 were credit sales. Because don't make the mistake of applying this percentage to your total sales. Make sure you're only applying it to the portion of your sales that were actually credit sales, because you're not going to have bad debt if you've already gotten the cash. So this is only relevant to the credit sales, or the sales for which we got an account receivable. So now we're going to move into our accounts receivables methods. These methods are very similar, and I like to think of these as balance sheet methods because we are applying our percentages to a balance sheet item. That balance sheet item is our accounts receivable. If you'll remember, in our previous method, we were applying our percentage to our sales number or our income statement number. When we're doing any of these balance sheet type methods, if you'll remember, the balance in accounts receivable builds from one year to the next, whereas a balance on an income statement starts over at 0 every year. So anytime we are applying our percentage, our estimate of bad debt percentage, to a balance sheet item, we need to keep in mind that this includes values for the previous years. So if we apply our percentage to the accounts receivable, and it includes amounts from previous years, and we book that as bad debt year after year, we're really going to be double counting the amounts that are in previous years. So instead, when we come up with an answer here, and we'll show this as we look through our examples, that shows us the total amount that should be in our allowance, but we have to compare that to what's already there, and then we need to make an adjustment to get it to what it should be. That seems very difficult right now when we're saying it, but let's go ahead and look at an example. To compute our bad debt expense using the accounts receivable method, we do the following. We take our total estimated bad debt expense, and we get that by calculating our bad debt percentage, or the percentage we estimate to be bad, and multiply that by our accounts receivable balance. That tells us what we should have as bad debt expense in total. We then compare that to what we already have in our allowance account, and the difference between those is what we are going to recognize as the current period's bad debt expense. Let's work through an example. So we have a company that has $50,000 in accounts receivable, and they have a $200 credit balance in in allowance for doubtful accounts. So what this is telling us is that we already have an amount in our allowance account. You can see here our allowance for doubtful accounts, and they're telling us we already have $200 in there. So they tell us that past experience says that 5% of our receivables will be uncollectible. So 5% multiplied by $50,000 tells us that the total amount that we want in our allowance for doubtful accounts is going to be $2,500. So we have to look at what we already have in the allowance account, $200 here, and what we need, $2,500. The difference between the two of these is what we will recognize for the current year. So bad debt expense of $2,300, allowance for doubtful accounts, $2,300. If we went ahead and booked the full $2,500, we would end up having $2,500 plus the $200 that was already in there. That would be too much. Because remember, we're basing this off of our accounts receivable amount. So this amount that's already in there is based off of what was in our accounts receivable in previous years. So we don't want to double count that. So instead, we go ahead and calculate what we should have, look at what we already have, and the difference between is the adjustment that we need. And that adjustment is going to be the current year's bad debt expense. Now we're going to look at the aging of receivables. This method is the same premise of what we were doing before, meaning first we calculate what we should have, we compare that to what we already have, and we make an adjustment. But instead of just using one specific percentage, we're going to end up coming up with different buckets based on the age of our receivables, and then we're going to apply different percentages to those buckets. So let's think about this. If we have a receivable that is 10 years old, do you think that it is more likely that we will get that 10-year-old payment or a payment that's maybe only 2 months old? I can go ahead and tell you, if someone has not paid you and they have owed you money for 10 years, it is probably slim to none that they will ever pay you. However, compare that to a receivable that, say, is only a month past due. It is much more likely that that person will pay you, but they're just a little bit behind right now. So based on that idea, we look at different buckets of the age of what is in our accounts receivable. So the more current something is, or the more recent it is, we're going to say that it is more likely that we will get that. The older something is, that means it is more likely that we will not get that. So let's look at how we do this. So we have our schedule of accounts receivable by aging, or this is our aging schedule. What you have here is the total amount in our accounts. You can see here the total amount in these accounts. We've got $50,000 in receivables. And then we're going to break this into buckets. So we have money that is not yet due, meaning that someone's supposed to pay us in the next little bit, but they're not past due yet. And $37,000 of the total $50,000 is still current. Then our next bucket is that it is 1 to 30 days past due. So it's around a month past due. It's not that late, but it is getting late. We've got $6,500 of that. And then we have other buckets, 31 to 60 days late. And then, whether it's 61 to 90 days late or over 90 days late. And you can see here these percentages. So of the accounts receivable that are still current, we estimate that 2% of those will eventually end up being uncollectible. And then, once we get into the first bucket of past due accounts, you can see this percentage increases. And the older these accounts get, the more likely it ends up being that we're not going to get it, because simply as time goes by, most people pay, and the longer it goes on, the less likely you're going to get this money. So that's why we see the increase in the percentage that we estimate to be uncollectible. You simply multiply these percentages by the total amount of receivables in those buckets, and these tell us the estimated uncollectible from each bucket. Sum those together, and you can see here, in total, we estimate 2,270 of these accounts receivable will end up being uncollectible. But again, this is a balance sheet method because we're applying these percentages to an account receivable or amount that builds year after year. So we're not going to go ahead and book this full $2,270. We're first going to look at what's already in our allowance account, compare that to what we think should be there, and we'll make an adjustment for the difference. So you can see here, building on our previous example, we're saying that they already had a balance of $200 in their allowance account, and we now know that we want it to have a balance of $2,270. So the difference between the two of these is going to be our actual expense for the current period. So this is the amount that we're going to book. So you show here we have our bad debt expense, and then we book that allowance for doubtful accounts for $2,070. When we make this journal entry, this is going to end up raising our allowance from $200 to the amount that we said it should be. So this adjustment gets it to where we said it should be at $2,270. And again, that amount is coming from this aging schedule. But we only make the adjustment for whatever it takes to get us to that required ending balance. So here we just have a quick summary of our methods. We've gone over these pretty carefully, so this is just a good way to go back and review as you're beginning your work. So now let's talk about notes receivable. Similar to accounts receivable, the basic idea of a notes receivable at this point in the class is not new. A note receivable is simply a promise to receive money at some point in the future, but a note receivable is typically more formal than an account receivable. There's usually some type of contract behind it, and then one of the key things with a note receivable is there is typically some type of interest rate that's going to be charged. So you see here just some terms. You can work on learning these on your own. Some of these may be new to you, and some of these may be things that you're already familiar with. But the most important thing is you can see there is a contract that backs up this note receivable. And then you can see here the interest rate is 12%. So anytime we have a note receivable, we need to be able to compute the interest for that note receivable. Because when we signed the contract, we said that as time passes, we promise to pay you a specific percentage for having borrowed that money. So how do we actually calculate that interest? So you can see here, this was a note. It was a $1,000 note, or someone loaned someone $1,000. It's a 90-day note, so basically a 3-month borrowing at 12%. The important thing here is this 12% is an annual percentage rate. So that doesn't mean they're going to get 12% over 90 days. They're only going to get 90 days worth of that 12%. So you can see here we've just got some information. Again, this was a note on July 10th. So we have to see how many days of interest are they going to earn in July. July has 31 days, 10 days already passed. So in July, they will earn interest for 21 days. Then they will earn interest in August for 31 days. Then they'll only get 30 days in September. And then the note matures on October 8th because that gives us to the 90 days. So in an example like this, it's kind of tedious to actually calculate when the note actually matures. But in most examples that you're working, it'll be more straightforward. It'll typically, just to make things easy, be that the note began on, say January 1st or July 1st. It makes it a lot easier than if it starts midway through the month. But you do need to pay attention to these days in case you have a note that's issued throughout the month. So how do we actually compute interest? We will compute it with the following calculation. It's the principal times the rate times the time. So in our example, the principal was $1,000 that was loaned. The rate, remember, that's an annual percentage rate of 12%, and then multiply by the time, 90 days out of our year, 360 days. Go ahead and just as a general rule, use 360 days. I know depending on leap years and so on, we have different days in a year, but the basic banker's rule is 360 days, just to round things out and make it easy. When we multiply that over the days in this note receivable, whoever borrowed the money is going to end up owing. They owe the $1,000 back, and once this note is finished or the 90 days has passed, they will owe $30 of interest. So how do we actually record that? If we are the company that issued the note, meaning that we are like a bank and we let someone borrow money, how do we record that? So you can see here we have an example. We've still got our same example, $1,000, 90 days at 12%. So how do you actually record this if you are the company that lent the money out to this specific person? You show that we have a receivable. It's a note receivable of $1,000. And then we have sales of $1,000 because this was for a sale. Now, I want to go ahead and note, we do not record the fact that this person owes us interest on July 10th. Why is that? Because the way interest works is interest is earned or it is owed via the passage of time. So we do not owe interest on this until time actually passes. So we don't actually have a receivable for that interest until time has passed. So then how do we actually value and settle our notes? Here we have a company, the principal and interest of a note are due on the maturity date. So we had a $600,000 note at 15%, and it was a 60-day note receivable, so basically a 2-month note receivable. How do we show that we are getting that note paid back to us and we're getting the interest? So we had originally recorded the note 2 months before, And when we recorded that note, we showed a note receivable and then sales, or if we had simply lent out money, we would show the cash going out when we originally recorded the note. Now we're showing that we're getting that note paid back to us. So what do we get? We get cash. We need to take the note receivable off of our books, and we need to recognize interest revenue because now time has passed and we have earned revenue. So you can see here the calculation of that revenue. We're not going to go over that, but that revenue ends up being $15. The note receivable was only for $600. And then when we add the note receivable plus the revenue that we earned, they're not going to just pay us $600. They're going to pay us the full amount of $615. What happens if we had issued a note and we find out that we're not going to get the note paid back to us? We need to go ahead and show that as follows. So originally we had a note receivable, but we're not getting paid back when we should. So what we do is we transfer that to an account receivable. You can see here we book an account receivable by debiting this asset account. We show that we earned revenue. It's irrelevant the fact that we haven't gotten paid that because we're surely going to continue following up with this person. So it's revenue. We earned it. Whether or not we get it, we'll book that with an expense when the time comes. And then we need to show here that it's no longer a note receivable because this 60 days has passed. So we're going to make this an account receivable, and we're going to continue following up with this person to hopefully get our money back. Now, early on in the course, we talked about adjusting entries, and these are entries that we need to make to get our books up to date. So now let's look at the actual calculation of an adjusting entry related to interest. So, if you'll remember, oftentimes a note receivable is something that is longer than a year. Or maybe it's a 9-month note, but it happens to cross over into 2 separate years or 2 separate reporting periods. Anytime we close a reporting period, we need to make sure that we recognize any revenue that has been earned or any expenses that have been incurred. And in this case, we're talking about revenue, interest revenue. So on December 16th, we accepted a 60-day note. It's a 12% note for $3,000. And then when we accepted this, it's a 60-day note. And remember, it was on December 16th. So on December 31st, we need to recognize the fact that we have earned some interest. This interest has not been paid to us, and it will not be paid until the end of this 60-day period. But the truth is because time has passed, we have earned some money, so we need to show that. The way we do that is by showing the portion that we have earned, or $3,000, multiplied by 12%, and then how many days have passed. 15 days out of a year, so 15 divided by 360. So how much have we earned? We have earned $15 of interest. So we need to show that we have interest revenue of $15, but we're not getting the cash for that interest right now. Instead, we have interest receivable because, again, that when we signed this note receivable, someone promised to pay us back the amount that they owe, and they're going to pay us the interest that accrues throughout the life of this note. So even though we're not getting the cash now, we can go ahead and consider this interest receivable because it's going to be paid to us. So then what happens when we actually get this money paid to us? When time fully passes, the full 60 days passes, we'll end up getting the $3,000 that was originally owed to us, and we will get the full amount of the interest. So the 12% interest for the full 60 days is $60 of interest. However, keep in mind, we have already recorded interest revenue of $15. If we go back, we already recorded the fact that we earned 15 of the 60 days. So we don't want to book that portion of interest revenue again. First, we want to go ahead and record the revenue that we have earned in the current period. That's 45 days of that interest. Remember, this was a 60-day note, and it crossed over 2 years. We earned $15 of revenue last year, so we're earning the other 45 in the current year. So we recognize we earn the other 45 days of interest in the current year, and that happens when you calculate that. That happens to be $45 of interest revenue in the current year. What do we do with the interest that was receivable? Remember, we booked a receivable back here when we also booked the revenue. When they pay us the full $60 of revenue, that $15 is no longer receivable, so we take that off. So, 3 things happening here. First, we book any revenue that has been earned. We need to get rid of the receivable because we are actually now being paid that amount. So when we sum these together, that's the $60 of interest. So the cash that we're getting is the original note receivable, the principal amount, plus the interest of $60. So what happens when we dispose of a receivable? And when we dispose of a receivable, I'm not talking about we were paid what we were owed, so that's not a disposal. A disposal is when we have a receivable, but we want to get rid of it for some reason. Remember, a receivable is a good thing. It is a promise that you're going to get cash. But there are circumstances when a company wants to get their cash now. They don't want to wait for time to pass. So there are things that you can do. You can sell your accounts receivable, or you can pledge your receivables, and these are simply methods of going ahead and getting your cash. A basic example is if you sell your receivable, what you're doing is you're going to sell your receivables to someone, and you're going to get cash today, and they in turn get your receivable. Why in the world would someone do this? That's because, let's say you had a receivable that was a $60 receivable. You would sell it to them for a lesser amount. So let's say you tell someone, I have a $60 receivable, but if you give me $50 of cash today, if you're able to hold on to the receivable, you'll get an additional $10 when they pay you. So that's just an example of a type of disposal of receivable. And then finally, we're going to talk about some ratios related to accounts receivable, and we're talking about the accounts receivable turnover. This is just a ratio that helps us to look at how quickly is management turning over their accounts receivable. And what we mean by turnover, how quickly are they getting those accounts receivable, and are they making sales from those accounts receivable?